Welcome to Founder Files, the podcast for growth minded leaders, investors, and operators shaping the future of business. Each episode dives into the critical decisions behind scaling, from finance and fundraising to leadership, strategy, and technology. Founder Files is powered by Cypher, the AI powered and human led finance partner helping growing companies scale with clarity and confidence. Learn more at cypherfin.com. You don't have much accounting knowledge and you've ever asked yourself, are my numbers actually right or just good enough for now? This episode is for you. One of the questions I get all the time from founders is around cash versus accrual accounting. Do I really need accrual? When does US GAAP or IFRS actually matter? And why does everyone suddenly care the moment investors show up? For SaaS AI and e-commerce founders especially, this topic is more than an accounting preference. It directly impacts how your business looks to investors, buyers, and boards. And we see a lot of smart founders get tripped up here because no one really explained this clearly early on. So today's episode is very intentional and very practical. It's an educational conversation, but it's grounded in real life examples we see every week, from companies preparing to fundraise, to founders thinking about an exit, to teams realizing a little too late that their reporting just doesn't actually hold up to under scrutiny. We're going to break it down to you this way. What cash versus accrual actually means, when it's okay to keep your reporting simple, and when that reporting simplicity becomes risky, how revenue models in SaaS, AI, and e-commerce change the answer entirely, why GAAP or IFRS isn't about being fancy, but about being credible, and what founders should be thinking about before fundraising, before an acquisition, or before merging with another company forces this issue. If you're a founder of a growing company in the tech or AI space, or e-commerce space, or really any business with growth ambitions, you have a specific goal in mind with your business, this episode will help you understand whether your financial foundation is supporting your goals or quietly holding you back. I'm joined today by Insaf, a senior accountant at Cypher. Just so you know why Insaf knows what she's talking about, she manages a portfolio of both PE and VC backed clients. She handles their financial reportings, and she has extensive knowledge in US GAAP and IFRS. So let's get into it. Insaf, thank you so much for being here today.
Thank you for hosting me. I'm happy to be here today.
I'm excited to have you here. So let's just get into it. Why are we even talking about accounting methods here on Founder Files today?
Because a lot of founders think that accounting is just about compliance or filing taxes at the end of the year, but it's more than that. It's a lot of the decisions. It's the health of the whole company can show through the finances of the company. And the reason why we're talking about accounting methods here today is because a lot of the founders start by cash accounting even without realizing what it is. Understandably so, because it's simpler, which we'll get into. But it's very important for them to understand the difference between cash and accrual and how that impacts their finances. And that also allows us to avoid any messy cleanups when we get to see the financials or at the end of the year.
Agreed. So in simple terms, what's the difference between cash and accrual accounting? Let's start there.
Yeah, I get that it can be overwhelming at first glance or the first time we hear it. But the difference really comes to one thing, and it's the timing. So when we're talking about cash accounting, we're booking the transactions, just like the name says it, when the cash moves in or out of the bank. And that's it. But
Simple.
very simple, yes. But when we're talking about accrual accounting, we're talking about the timing of the transactions should be as they are happening. So we're talking about revenues being booked as they are delivered or rendered to the clients, and expenses when they are incurred, regardless whether they were paid or not. So the cash doesn't really matter. So like I said, it's mainly about when the transactions are being recorded on the financials, and regardless.
So many early stage companies do start with cash accounting, and oftentimes it is okay, but
Yeah.
why is it that a lot of the early stage companies prefer to start with cash accounting?
It's just intuitive.
And simple.
Very simple. It's what you would do with your personal bank account. You would see money coming in, that's your revenues, money going out, that's your expenses, and that's it. And it makes sense at the
Yeah.
early stages of the company, because what most founders need to know at the beginning of their journey is how much money they actually have in the bank. That's what matters most.
Yeah.
It's simple, easy to understand, and doesn't require a lot of maintenance. You don't need to have many documents all around. As long as you know what is coming in and what is going out, you know
Yeah.
the nature of those transactions.
And when you're in your ideation stage or early stage, really what's important to you is your cash visibility. So
Correct.
your cash accounting is what is going to be the easier options to keep track of your cash and cash inflows and outflows. So what are the
Exactly. Yeah.
main pros and cons for each method if you in simple words?
Well, let's start with the cash because since it's the one that we start with. So when it comes to cash accounting, I would say the first pro is that it's simple. It's easy to deal with, even as a sole owner of the company, sole person of the company. You can just manage it on your own. It's simple, like we said, doesn't require a lot of maintenance. But the cons, on the other hand, are that it does not take into consideration anything that is not paid. So, any obligations that you still have with your contractors, any ongoing work that has not been invoiced to you yet and not paid, any revenues that you already have, either services rendered or products that you've sold to clients and you haven't cashed in yet, you won't see any of this on your financials. And that impacts the decision making because at the end of the day, what your financials look like would be they would either look very good or the worst they could look like compared to what the reality actually is. So it can be very deceiving what we have on the financials when we use just the cash accounting.
I guess in other words, accrual accounting would be well, I guess cash accounting does not really show the true performance of a business, if we want to
Exactly.
say it in different words. So we said that it was best suited for early stage companies. What other companies are okay using cash accounting? I would say, sole proprietors, service based businesses. But what's really important to take notes of here is that it is okay to use cash accounting if you don't have specific goals in mind for the company to either exit, merge, or IPO, or other goals that we may talk about in just a few seconds. Let's talk
Correct.
maybe first about pros and cons for accrual.
Correct. We
Let's
didn't
do
miss
that.
that.
Yeah.
Yeah, let's go back to that. So, when we're talking about accrual, I think we can definitely see the pros within the cons. What I mean by that is accrual accounting, for example, requires a lot of accounting hygiene. We need to know every single thing that's happening within the operations, even if the operations is not tightly linked to the finance team, but
Mhm.
we still need to be communicating everything. So if there is any ongoing expenses, any ongoing revenue or services that are rendered to clients, we need to know that.
Yeah.
And so that is just a glimpse of the things that we need to take care of when we're working on an accrual basis. But the pro or the good side of this con is that it keeps your books intact,
Yeah.
basically, and it's it's bulletproof at this point because you have everything within your accounts and nobody can come to you and say, hey, why is this liability showing just now? Why didn't we know that you still needed to pay this or that person? Well, we already accrued it, and that's the main point.
Okay. So maybe can you walk us through how revenue and expenses are recognized under each method?
Yep.
Because you did give a few examples just now. Let's start with expenses. It's simpler to understand. How
Yes.
are expenses? We know how it's treated in cash. You already explained it, but how are they treated in accrual accounting? As you just talked about accruals, can you give us more insight when it comes to that?
We can talk about a few examples. I'd rather start with what we call the prepaid expenses. This is definitely not something that comes up on cash accounting, just on accrual. So we're talking about prepaid expenses when there is something that is either invoiced in, for example, a bill that comes in from the insurance company or the rent company, and that bill is covering the whole year, for example, or 6 months. So instead of booking all of that expense within just 1 month when it was received, we book it throughout the period that it is actually covering. So, an example, like I just said, is the insurance coverage. Usually it's a 1 year subscription. And so instead of booking, let's say $12,000 within January, we book $1,000 each month for the expenses. But the rest of that bucket, I would call it, I usually call them buckets, we would book it into the prepaid expense account, and that's a balance sheet account. Does not impact your profit and loss directly. You just take chunks from it each month to recognize the actual expense that you need to recognize. Like I said, rent as well. It could be just a 1 month difference, but that difference makes a difference on the P&L as well. So it's good to always make sure you're recognizing your prepaid expenses when they are actually happening or for the periods that they are covering.
So what I'm hearing is that not only there is a impact on the P&L, but also on the balance sheet with new accounts being introduced,
Exactly.
which we'll get into also in just a few minutes. So what about revenue? From a revenue standpoint, how does
Right.
accrual change the game?
Exactly. That's the good stuff. So a lot of the times what we see, and this is especially the case in SaaS companies who invoice subscriptions, we see that let's say we're invoicing a client for a subscription, an annual subscription, and we're booking that sale all in 1 month. Let's say we invoiced it in February when it's actually covering the whole year from February till January of next year. So what we do in accrual, again, very similar to prepaid expenses, we're now introducing a new account called deferred revenues. That's also a balance sheet account. So when we're booking that bill or that invoice to the client, we're booking it to that bucket, again, of deferred revenue. And we're only recognizing each month the exact amount of that service that we have actually rendered to the client or the products that have been sent out to them at that period of time.
All right, love it. Very simple to understand. So very practical explanation. Thanks, Insaf. There's one very important point that I really wanted us to make today is when you have accrual accounting, when you're doing accrual accounting, does that mean you're automatically US GAAP compliant?
Yeah, that's a misconception. And no, when you are on accrual, that's good. I mean, that's a start. But that does not necessarily mean that you are US GAAP compliant or IFRS compliant for that matter. There are certain standards and principles that have to be in place before we can call it GAAP or IFRS compliance.
Exactly. And the other way around is US GAAP requires accrual accounting, so you do have to have accrual accounting in order to be US GAAP compliant, but
Yes.
you need to have, like you said, additional rules put in place and taken into consideration to be US GAAP compliant or IFRS compliant or wherever you are in the world GAAP
Exactly.
compliant, depending on which GAAP you follow. So what are maybe some top three um, let's use US GAAP words
Okay.
so we don't get too confused because we do work on both US GAAP and IFRS. But what are top three ASC guidance that SaaS companies or AI companies should look out for if they want to be US GAAP compliant?
I love that question. And I do think that for our listeners or our viewers today, if they Google right now what we call ASC, which stands for Accounting Standard Codification, if they look up on any search motor right now, ASC, the first one that will come up is ASC 606, and that's for revenue recognition,
Yeah.
which is very, very important. And 606 dictates exactly how revenues should be recognized depending on the type of service or product that you are delivering, the timing, like I said, the type, and also multiple regulations depending on the situation of the company because it's not a one case fit all. It's multiple cases. You could find, for example, within the same company, multiple types of revenues that require different types of recognition. So we could find, for example, revenue that is usage based. So it's based on the percentages that we're using for each month. While on the other hand, you can have consistent monthly amounts that should be recognized. Or it could be a one-time thing, like when the service is done this month, invoice this month, that's it, in the end of the
Yeah.
deal. So it's really a lot of these regulations and guidances that are within this standard. The top second, I would say, is the anything that's related to capitalizing costs and assets capitalization. And here we're talking about a few of these ASCs. We have, for example, ASC 350-40, if I'm not mistaken.
For yeah,
Um, and we also have 360. We have a couple others ASCs, and each one depends on what type of assets we're talking about. So there are standards for how to capitalize to begin with. There are others that are in relation to the type of asset of expenses that you have within your development costs, and which of those would be capitalized, and that's definitely impacting both statements,
yeah,
both financial statements. We're talking about P&L impact, balance sheet impact.
yeah, which is relevant to SaaS and AI companies that are
Very,
investing in technology. So their development costs could be on the balance sheet instead of the P&L.
exactly.
So that's a really good guidance
Yeah,
to take into
definitely.
consideration.
Yeah, there are lots of nuances within them. They do require a lot of research and
And a good
memos,
memo. A good memo.
good memos. That's true. And they also depend on what type of technology are we investing in. Is it intended for internal use, or is it intended for marketing reasons or for external
Correct.
clients? And the rest goes on for anything assets related. The third one I would say, which is very important and looked upon a lot of the times, is the lease. We have what we call ASC 842, and that mainly requires us to book the lease, even very similar to if we purchase the asset, I would say. I don't want to get into too many technicalities here, but whatever lease you have within your business has to be
Yep.
recognized on your balance sheet, basically.
So thank you. That's perfect. So top three, your SaaS AI company, top three to look out for: revenue recognition, capitalization of software cost, and then
Yes,
lease
and then
accounting.
lease,
These are the three that we come across very often.
for sure.
Let's go back to revenue recognition. I love that topic.
Likewise,
You know
same here.
how it's probably like the main one we come across very often for each SaaS and AI company. You did mention that revenue recognition could be different for each company, which is very true. But also within the same company, there could be multiple revenue streams that
Correct,
have
yes.
different revenue recognition principles that can be studied differently depending on contracts,
Exactly.
etc. Um, let's just maybe give like a real life example. We've come across SaaS companies, actually an AI company that comes to mind right now that had different revenue streams, and also who was very confused about understanding the difference between recognized revenue, invoiced revenue, bookings, cash
Yeah.
received. It was all very confusing until we set up the processes to organize everything. So let's talk about that.
Absolutely. It was definitely an interesting experience that we had with them, because we went from a place of uncertainty and confusion to a place of clarity and full accountability for any figure that we have within that month for any type of service. And for a lot of SaaS companies, I imagine it would be the same case, where we would have subscriptions to
Mhm.
their software that they're offering to their clients, plus additional items. Could be, for example, services when they set up that
Mhm.
client for the first time. It could be additional ad hoc services throughout the contract. And they could also have the revenue stream that is more usage based, depending on how that
Yep.
software or that platform is being used.
Which was credits in this case, if we're talking about the same
Exactly.
case
Exact.
study.
No, it's exactly that one. So we would have credits. So, for example, when we're talking about the access to the software, that's a very classic case of subscription, where we would recognize the revenue um, consistently, same amount every month, depending on the period of that subscription. Come to the services, that depends on when those services were actually delivered to the client, they
Yep.
were rendered to the client. So I could, for example, invoice my client for services that they're expecting me to do in, let's say, 2 months' time,
Yep.
and I wouldn't recognize them on my P&L until they are actually delivered, and I
Yep.
would keep them in my old bucket of deferred revenue in the meantime. And when we're talking about credits, which we are using as, let's say, coupons to use that software or platform, we're talking about usage based, because those credits could be used as of 10% this month, maybe 30% next month. So we would
Yeah.
need to know exactly how much is used up until a certain point of time, and that's what we would recognize. But that also requires a lot of understanding between the operations team or the sales team and us, finance team, because we would need to understand if they are keeping track of those percentages very meticulously, because otherwise it could be very challenging to recognize them without a specific number. The other thing that was confusing is just understanding the differences between, like you said, the bookings, invoiced amounts, etc. So that is mainly when we set up the process with the client. I believe they were, and we were able to meet in the middle with them, where they were able also to provide us enough information to work with the data. So they understood that the booking is when we close the deal.
Contract value.
Exactly. So it's not going to be accrued or on the books
Or on the books
until
yet.
we know that the term has started, if that
Yeah.
makes sense, or the invoice was issued, and we have to have it in the deferred revenue bucket. And then we come to the moment of invoicing. Again, we wouldn't necessarily recognize it until it's actually time to recognize it. I don't even know how many times I said recognize today. I should have $1 for each time I said that. But when it's invoiced, that's that. We'll keep it in the deferred revenue until we get the information that that amount should be recognized within the month. And
Yeah.
that's when we finally make journal entries to move those revenues from the deferred revenue to their
To the
corresponding
actual
revenue account.
So can you believe how many things you need to keep up with? I mean,
I know.
if you're a founder and you just booked a contract, closed a contract for $3 million, you're already thinking that you made $3 million worth of revenue, which is not the case.
It's
So
not.
bringing that information, that news to them could be very confusing.
It is, yeah.
Which is why we always keep also a KPI dashboard to show and give visibility of what bookings happened during the year, what invoiced revenue was, and what actually recognized revenue on the P&L is, and how the three of them are connected. It's also really important to note, I think, that the accounting software always recognizes revenue based on what's invoiced.
Exactly.
So if you don't have the knowledge and the expertise to know that you need to recognize your revenue with actually adding journal entries every month, or you can automate it with other tools that exist today to recognize your revenue properly based on your revenue recognition principle, then you're assuming that the accounting software is already doing it because you've already invoiced that customer,
But not necessarily.
and then your revenue is wrong, overstated or understated.
I think one thing that I would like to add is also in moments where we have recurring revenue that should be invoiced to a client.
Yeah.
At least that's the agreement we had with them. And we end up, for one reason or another, not invoicing them during that period of time.
Yeah.
So question is, where does that revenue go? We still need
Yeah.
to accrue it or to recognize it. That's when having a very clear idea about what is going on in each month makes so much sense in terms of having the accounts recognizing exactly that, regardless of what other parameters are in place.
Yeah.
So the more controls you have, the
Exactly.
better.
To avoid cutoff issues. That's what we call also
Ex-
cutoff issues
True, yeah.
in accounting. So this was all really good information. Could be maybe still overwhelming for some founders that could be listening. We do have memos and checklists that we can share with you for SaaS US GAAP guidance. So every US GAAP guidance that you need to know and look out for if you are a SaaS, AI, or e-commerce business will be on this memo, so we can share it with you. Just drop us a message. And we also have a US GAAP checklist that we
Yes.
also follow very tediously
Yes, we
to make
do.
sure that our reporting is US GAAP compliant.
That, and also being able to communicate. The checklist basically helps us communicate with clients and founders with terms that are just more common to use and not overwhelmingly technical.
Yep.
And it's just a good ground to start from. Checklists like this just help us, be on the same level with our clients and test the readiness of everyone included in terms of working on certain standards, because they can be extra work
Yeah.
for people who are not used to them, but they definitely pay off.
Yeah, I totally agree. I touched on KPIs, and I did have a question here about how using cash accounting or not having accurate reporting can lead to making it hard for you to track SaaS specific metrics like MRR, ARR, gross
Correct.
margin and retention, etc. Those KPIs require really good processes between your sales team and your accounting team, between what's on your CRM and what's being translated into your accounting software.
I mean, I do find that CRM tools are very helpful in this matter when used correctly. So there are definitely a lot of features within them where you could include whether that subscription is annual or monthly or quarterly, depending on the situation. And that already communicates to us, the accounting team, from the sales team, what's going on with this deal. So that's the
Yeah,
first layer of help. When it's not there, or when, for example, we're not on an accrual basis, we find ourselves booking an entire subscription within 1 month.
yeah,
And then next month we would look at the financials and say, well, how much is the actual it I can't even formulate the question because it doesn't make sense to have MRRs and ARRs when we're talking about cash accounting. So, if we were to speak just about accrual accounting, I would like to just highlight the importance of knowing exactly the duration or the terms of the contract for us to be
yeah,
able to deliver the exact metrics, whether it's MRR or ARR, to our clients,
yeah.
which are recurring revenues, monthly or annual. That's
And they're recurring, and whether they're recurring contracts too is really important, because you could have a 1 year contract, but that doesn't mean that it's necessarily an ARR
that's true.
if it's not a recurring one. Um,
And we're also talking about retention and churn. When we don't have ARR and MRR in place, how would we know if a client just stopped using
yeah,
our services? It's really hard to understand the churn and retention of the company, and those are very, very important KPIs to any
yeah.
SaaS company specifically.
And again, this could get really quickly overwhelming, especially when you have a high volume of transactions, integrations between CRM and accounting software, including, your accounning team being on top of that. And also maybe utilizing some tools to help, like Maxio is a really great one for billing when
Yeah.
it comes to um, a high
Also,
volume of subscriptions,
correct,
and revenue recognition is also something that Maxio helps with. But again, it does require expertise and someone to manage it,
for
because
sure.
it can be very heavy to
To
manage.
handle, yeah, I agree.
That's great. Okay, I think we covered a lot of good things here. What are some of the gap that why is it that, okay, we talked about US gap being important. Why is that? Why don't we just say, okay, we're doing accrual accounting. I'm a founder who doesn't really think I need to have US GAAP reporting at this time. Why could we argue otherwise?
Well, because US GAAP unites all parties included in the realm of finance, we're definitely touching on the law here as well. What our listeners should know is that US GAAP is legally required when the company is a public
Public.
company.
So
So that's a must. There's no discussing it. But then on the other hand, when we have situations where US GAAP is not essentially legally required, but it's effectively preferred by everyone included, we're talking about companies that are audited. We're talking about companies that aim for exits or VCs, among other
yeah. If you're planning
situations.
on being VC or PE backed, VCs and PEs sometimes strongly prefer, if not actually require, US GAAP reporting. We are actually going through an exit right now where we were
Which is very,
asked,
very exciting.
very exciting, but we were asked, US GAAP questions, and the PE purchasing our current client. Um, required US GAAP reporting. I
Yeah,
mean,
and
so we had to make sure that we responded to the questions. So we had to make sure to send our memos, and we were glad that we were prepared for this because otherwise it could have really hindered due diligence and
for
slowed
sure.
down the deal, if not actually broken the deal completely. And I've actually seen that happen.
I mean, even with all that preparation, we still had questions from them.
Questions, yeah,
Are
and
we,
challenges.
yeah, are we respecting US GAAP within this account and that account? Is the method or the process US GAAP aligned? So we still got those questions regardless of those memos and preparation. So
Exactly.
there's a lot of back and forth. So might as well be used to US GAAP as soon as you can.
If you're also aiming to have institutional lenders,
Hmm.
bankers, they will ask for US GAAP reports. They may also, with giving you loans, require audits. And if you're going to be audited, you need to be US GAAP compliant.
That's
So
true.
if you have any of these specific goals, it's better to start now than to have to clean up later. Because if you have to become US GAAP compliant after 2-3 years of not being following US GAAP, it could be really painful to have to clean up and go back in time to adapt your financials. If you're a franchise as well,
I
that's
see.
really important to note. If you're a franchise, you need to have US GAAP reports because you are going to be submitted to audits. Um, yeah, so your investors as well will probably be a lot more comfortable and think that you have much better credibility if you present US GAAP reports rather than non-compliant reports. Um,
Maybe our founders may debate that they could do the cleanup for the year and call it a day, and that's it. But the thing is, there's a lot of going back to historical data and comparing this year with previous year. And it's not easy when you have, let's say, 2025 US GAAP aligned and 2024 and 23 are not.
yeah.
So that's 3 years worth of cleanup that should be done, let's say, in 1 month before your investors come in. So, like you said, the earlier you know about it, the better the cleanup is going to be and
And the
the less of
studying
it.
that comes with that, like we talked about all the rules to follow, having to go back to contracts to study your revenue recognition. If you don't have properly documented revenue recognition principles, that will require the experts to come in. It could get expensive. Insaf, what's the final word today?
I would say final word would be there's no shame in having your accounts on a cash basis if you're just starting, as long as you're understanding the limitation of cash and know when you should start asking about accrual accounting. Understanding how accrual accounting also is very important.
Hmm.
Everyone should know that accrual is very decision effective, and it's the only thing that represents the actual truest
Hmm.
image of the health of the company, the financial health of the company. I would say those are the main two
Yeah.
takeaways today.
I'd
Um,
add one, maybe just know your goals because that's
yeah.
what, dictates how you need to keep track with your numbers.
Yeah, if you know your goals, you would know at least when to
When to
look,
switch,
when to switch,
to
or
ask
when
for
to
help.
start asking for help or looking for one. Yeah, that's true.
Awesome. I loved today's episode and stuff. I think it was super educational.
Maybe super
We covered
technical,
a
a bit
bit technical.
overwhelming.
I hope not. I hope it made sense to the listeners. But thank you so much for being here today. I think you were
Absolutely. It's a
very
pleasure.
insightful. And Cypher is lucky to have you. And cheers to the next episode.
Lucky to be in Cypher as well.